We've highlighted over many appearances with you the challenges and the strengths that Netflix has demonstrated over the years. What you looked at the results and the comments, also Reed Hastings, that news. What's your feeling this morning about prospects for the company and the stock?
Well, before I go into that, I got to mention one thing more important than that. Today is the 37th anniversary of the launch of CNBC right in this hour. So very important. We launched it then, and look what you've done with it, Joe.
Ted David and Sue Herrera? Is that
right?
Is that right?
Right.
Yeah.
Right.
I was at a competitor at that point that you, I think, urged Jack and Bob to put out of business, and that's a good thing to do with competitors.
We acquired them in bankruptcy. You're absolutely right.
And thanks a lot, because I was living. That was in Marina Del Rey, and you moved me to Fort Lee. Thanks for that when you bought us.
Well, look what you've done with it, Joe. Yeah, congratulations.
Right. Thank you.
Back to Netflix. Look. This 10% down in the stock this morning, like often with Netflix earnings, I don't think the stock market reaction has it right. I think the Netflix story is very much intact. Strong double-digit growth in revenues, doubling cash flow, on track to double ad revenues. Operating margins over 30% and on track for good operating margin growth for the year. And it's clearly, with its profit, with its programming budget, with its low churn, with its ability to raise prices, in a totally different realm than any of the other long-form entertainment streamers. Having said that, clearly there are some things that are not so bright. When they stopped reporting subscriber numbers, they made a big deal about focusing people on viewership, engagement, and they gave basically no empirical data on engagement, leaving real head scratching about some internal metric that they were not releasing, which they said was going well. Yes, they said that overall hours of viewership are up, but of course they're going to be up when your subscriber base is growing. The question is viewership per sub. And I think with YouTube competition, with competition from free advertiser-supported streaming channels, they're clearly growing much faster in viewership than Netflix is. And that's an issue for the long term.
Yeah, growth has been something that the company obviously has been concerned with. That may have been the reason for, what would you call it, an ill-fated approach to try to buy Warner Brothers, or was it worth a shot? It seems like it hurt the stock. Maybe it's temporary.
Well, I think it clearly hurt the stock, and it clearly raised the issue in a lot of investors' minds. Do they need to do this? I don't think they needed to do it. I think they're going to win far and away the long-form entertainment streaming game with or without that acquisition. And quite frankly, spending over $70 billion for library assets that I think they're going to be able to acquire in the market without anywhere near that kind of huge investment and leveraging up the company. In the end of the day, I think it was a smart decision not to pursue it. And maybe the biggest reason for that is not the immediate financial issues that it may have created, but the fact is that in the intermediate term, it really looks like the challenge they're going to face is not access to traditional library content, but what's going to happen with AI-generated content, both professionally created AI content and user-generated AI content. We're seeing YouTube's viewership growing by leaps and bounds. YouTube today has 50% greater viewership than Netflix does on the TV. And with that, you really have to wonder if AI and video tools that give users the ability to put out first-rate content, and YouTube is the beneficiary of that, is the growth of that kind of content really the challenge they need to look at? And $70 billion in the direction of traditional TV may well have taken their focus off of what they may need to do to meet that next programming challenge.
Tom, has there been any slowdown in the rate of cord cutting and the ascension of streaming to supplant everything we've ever thought of? Is there anything good happening in legacy media at this point? And you are a Versant senior advisor. I know I've mentioned the stock a few times, and maybe some of the sub losses that we've seen from other legacy media company. Is it slowing at all, or is it just the ice cube, the sun? Maybe there's a cloud in front of the sun briefly for the melting ice cube.
Well, there is some good news, actually. The CEO of Charter, Chris Winfrey, really has been out there doing something that back when Reed Hastings was really getting Netflix streaming going, and I was CEO of TiVo, we tried to do, and the cable industry wasn't interested, and that is packaging in streaming channels with the cable bundle. And Charter has taken the lead on doing that, and the initial results look successful. Charter's churn is down for the first time, the cable bundle. All this has a lot to do with YouTube TV and not necessarily cable operators per se, but the cable programming bundle actually gained subs. And we may be seeing, if there's broader marketing adoption of this, how do you provide at no extra charge to the cable bundle viewer both cable channels and streaming services? We may find a new way to make sure that linear traditional television isn't suffering the rates of decline that it has over the last few years. So that's a very promising sign.